Do you ever feel that you're paying a little too much in tax? Well, if you do, this episode is key because we're going to walk you through some key strategies that you can employ today in 2026 to help you save some real taxes.
We hope you've been enjoying all the episodes from the Secure Your Retirement podcast. If you'd like to keep learning and receiving these episodes, then hit the subscribe button and turn on notifications by hitting the bell so you receive alerts when each episode comes out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
So we're having to get ready for all the tax strategy meetings that we got coming up. And last year we did over 150 tax strategy meetings. And one of the things that I got out of it was that we really kind of came down to four really big components that we were talking to a lot of our clients about. We talked about qualified charitable distributions. We talked about donor advised funds. We talked about tax efficient portfolio management. And then we also talked about Roth conversions. And I think when you first start talking about that with people, sometimes you say the words QCD or DAF or donor advised fund, and people just don't even know what we're talking about.
Right.
I'm curious from your perspective, how do you, first of all, let's just take the first one. How do you describe to a client what a QCD is? Like, how do you describe that?
Yeah. So QCD being a qualified charitable distribution, the first thing I do before I even explain it, I say you got to be charitably inclined, right? If you're not charitably inclined, then there's no scenario where it makes sense to just give money. You're still giving money away, right? So it doesn't make sense to just give money away if you don't have a purpose behind it. Now, if you are charitably inclined, and then also you're of the age of 70 and a half, which is to qualify for this strategy, a qualified charitable distribution can make a lot of sense for you. And how it works basically, and I think it gets kind of forgotten that this is even something that you can do. People don't talk about it enough. But how it works is you take money from your IRA. Now, normally when you take money from your IRA, you're going to be taxed on those dollars. When you make a withdrawal from your IRA, it's fully taxable. People don't like doing that. But this, you could almost call it a loophole, a charitable loophole, where if I do it correctly, and there's a process to it that we have to do right, but if I do it correctly, I can pull that money out of the IRA, send it directly to the charity, and normally a distribution is taxable. In this case, it's completely tax-free. So just think about that for a second. If I'm talking to the client, they need to understand the power of this, right? Because they put money into the IRA, tax deferred, so they got a tax benefit by putting it in there, so they never paid a dime of taxes on it, and then they got growth along the way, and then they got it out completely tax-free. It's about as good as it gets.
Yeah. I mean, I love it, and I think people love it when they do that. I think another one that for me, when I talk to people, I get excited about the donor advised fund. And I know, again, this does come back to that whole idea of being charitably inclined.
Right.
But donor advised fund is very powerful. And the reason why I like that one so much is I think a lot of our clients do give money away every year. But what they know is that today it's very hard to get tax benefit from giving money to a charity. So, and the reason why is because most people today don't itemize anymore. And the reason why they don't itemize is because the standard deduction on our tax year is so good and big, it doesn't get us into the point of being able to itemize. So what a lot of people do, and I always use the example, is let's say a client's giving away annually $15,000 a year, and they're doing that to multiple charities. Maybe they're doing it to one charity. That part doesn't matter. So, but anyway, they're giving away $15,000. Well, if I give away $15,000 in a year, I don't get to itemize. And the reason why is because I'm still below my standard deduction. So a donor advised fund is a really nice tool, because if I know I'm going to give away that $15,000 every single year, I could stack those donations. And we typically talk about stacking 3 years. So if I took 15,000 times 3, $45,000 I'm going to give away this year. That is going to throw me into itemization. So now I'm going to get to itemize, and I'm going to now be able to deduct some of my contribution or my donation. I'm going to be able to deduct some of that this year, and I get the benefit. So now what I get to do, I've got the $45,000 in my donor advised fund, I still give away $15,000 a year. I can always change my mind. I don't have to give away 15,000 if that year I'm not really liking the charity, or I want to give it to a different charity. I'm not committing it to the charity, but I have the ability to still give that money away, but I get all the tax benefit in year one. Then in 3 years, I just redo it. And the other nice thing is people sometimes ask, well, what if I pass away and I got $45,000 and I never gave it away? Nice thing is my beneficiaries can give away the money for me, and they can continue to do that mission, if you want to say it. So I think it just gives us so many options. But I think that leads us to another topic. I mean, that's all around charity, but when we think about another thing that we talk a lot about, which is tax efficient portfolio management. And I'm curious because it is a little bit, when you say that, people go, well, what does that even mean to be tax efficient in their portfolio? So we're really talking about non-IRA money here.
Right.
How would you describe to somebody, like, what does it actually mean to have a tax efficient portfolio?
Yeah. So I think the concept, and I think a lot of people understand the concept of um, uh, harvesting losses from your investments. And what most people do is they wait till the end of the year to say, hey, what's at a loss that I can sell in my non-qualified or my taxable account? Why that account? Because it's subject to capital gains, interest, dividends, and it can make a mess of your tax return if you don't stay on top of it. So what a lot of people do is at the end of the year, they're going to sell what's at a loss, and then also sell what's at a gain to kind of offset. And what the progression of that strategy is what we call direct indexing with tax loss harvesting. So in a lot of scenarios, you end up in this place where you don't have any losses to sell, and so the strategy is just kind of done. This tax loss strategy is very limited. But if we have a system where instead of managing funds through a handful of different ETFs or mutual funds, which they have their place, but if we want to be tax efficient, what we try to do, step one, is index. So what is indexing? Indexing is, think about the S&P 500 or the NASDAQ or the Dow. Those are major indexes. Now today you could go buy one ticker that represents all of the stocks within those indexes, which is easy, but it's not always the most efficient. If we want to be tax efficient, it could make a lot more sense to go buy enough stocks that represent that index. So the S&P 500, 500 stocks. Do we need to buy all 500 to represent the index? In fact, the way the indexes move is you really only need to buy about a third of those, if that, to get the true movement of the index itself. So that's step number one, is replicating the index and the performance of the index. If the index is up 10%, you're going to be up somewhere around there. If it's down 10%, you're going to be down somewhere around there. But now what we've done is created a bucket, or almost a playground, for tax loss harvesting. So when you have that one ETF or that one mutual fund and it goes up, well, now it's in a gain position. And we're in a place where we can't really optimize or do any harvesting. But if we have 70 to 90 different stocks, well, we all know that they don't all go up at the same time. And so some are going down, some are going up, and this creates this ability to do that other thing, which is actively tax loss harvesting, not at the end of the year, but throughout the year. So something happens in the markets, stocks go down, we immediately sell some of those for a loss, replace some of those stocks with equivalent types of industry stocks. So we're maintaining our index exposure, but now we've just harvested a loss. Now, what do we do with that loss? Well, we can use it to offset some gains so that we keep our index in line. Or best case scenario, we don't need to use that loss and it applies to our tax return next year and gives us a major tax benefit. You know, in this strategy, we talk a lot about how it works for tax efficiency, but I mean, you've come across so many scenarios where you've got somebody that has a tremendous amount of IBM stock or GSK stock, or they feel overexposed. So how do you handle that conversation?
Yeah, so the nice thing there is a lot of times people come in, if let's say they got a stock. I always use NVIDIA. People got that NVIDIA stock and it did really good and they're excited, but now they find themselves in a very big dilemma. And the dilemma is that they go, wait a minute, I've got this portfolio now, and NVIDIA is now 75% of everything I own in this account. And they go, I need to divest of this, but then they got that big tax problem that they're worried about. So what's nice about the strategy that we use with the tax loss harvesting is that we can now introduce other stocks that, again, go back to what we talked about. It mimics that index. Let's call it the S&P 500. And I can now start creating losses. I don't give up any of my gain, by the way, but I can create losses and sell some of my high valued stock, and I'm not really kind of creating a taxable scenario. Now, if I've got a really big position and I'm really wanting to get diversified, we're going to talk to the client about saying, hey, do we want to have a capital gain budget? So let's say the person says, I'm willing to accept $25,000 a year of capital gain exposure, then yeah, but we can put that, but we're taking a lot more than that off the table because of the fact that we've got the stocks there that are going to create those losses. So it just gives us a nice opportunity to help a client to divest this large holding. Is it going to take time? 100% it's going to take time. And we need to talk that through.
Yeah.
Anyway, I think another thing that segues into when we think about those different elements of the area around tax planning is Roth conversion. And that's gotten a lot of I don't know, news and media where people say, man, the Roth conversion always makes sense. And one of the things I always say to people is I say, everyone should not do a Roth conversion, but everyone should do a Roth conversion analysis. So how do you explain to a client, like, what are we trying to do when we do a Roth conversion? Like what is it we're trying to make sure that we manage?
Right. Yeah. With the Roth conversion, we want to be managing our, not just this year's tax, but our lifetime tax liability. And just take a second and think about all the dollars that while it was nice when we were working and putting into these tax deferred accounts like IRAs and 401ks, getting that upfront tax benefit, oftentimes in meetings, people say they didn't tell us about this thing called a required minimum distribution that I'm going to be forced to start taking at the age of 73 or 75. They didn't tell us this, and I saved into this, and now I've grown, and I've got $1 million in an IRA or 401k, and I don't really need this required minimum distribution, but I'm now forced to pay the tax on it. And that distribution can send someone into a place of higher tax brackets or Medicare IRMA surcharges. And so the only way to get away from those types of issues that could come about is reducing our IRA balances. Well, one of the most effective ways to do that is that Roth conversion. Luckily for us, we have Taylor Wolverton on the team, who is our Director of Financial Planning and Tax Strategy. So she's that CFP brain, but also she's an EA, so she knows everything about taxes, and she loves strategizing around Roth conversions. And so, we're about to jump into a ton of tax planning meetings, and we know how those meetings go. But from your perspective, kind of take us through, and in that meeting, what is Taylor doing and walking through to help someone understand the power of a Roth conversion, and does it make sense?
Yeah, I think that what we have to have in order to do this the right way is we've got to have some technology. And most people understand our tax code, that there's different levels or tiers. And sometimes people think if you get into the next tier that all the dollars from that back are taxed at that rate. So if they're at a 10, then they go to a 12 or a 22. They think, oh man, now I'm going to get taxed 22% on everything. But that's not how it works. It's only the portion of money that's in that category that gets taxed at that. So one of the things that Taylor's doing and what we're trying to analyze is, if I have a client who comes in and we say we want to fill up the 22% tax bracket because I know I'm willing to spend 22% to convert this amount of money, will it make sense? And when we talk to people, we use examples, and one of the examples that we use is Frank and Lily. Frank and Lily, they are real clients. They basically said, hey, we want to convert. We want to stay in the 22% tax bracket. And so when we did the analysis, basically we were able to take $66,000 a year, fill up that 22% tax bracket, pay only 22% on it. Our effective rate on that was actually much lower than that because we weighted it across all the money. So they got a very good conversion rate. But here's the power of it. We're going to do $66,000 a year, and we're going to do that over a number of years. And what that translates to them over the lifetime of their plan is $320,000 of tax savings. That's huge when you look at it. $320,000 over their lifetime of pure tax savings. And what we did not have to do there is in order to make the numbers make sense, we didn't have to use high rates return. We did not have to say that tax rates are going to go up in the future. We just used their situation, and it made a huge impact on how that all played out.
Right.
So super powerful.
Right. And the idea of tax rates going up in the future, I think if you're in a room of 100 people and you ask how many believe that tax rates are going to go down from here, and you ask them to raise their hands, no one's going to raise their hand, I think. Most people are of that mindset that it could go up in the future. So the idea of a Roth conversion, I tell clients that it's really, I think, twofold. It could be summed up to two major reasons as to why to consider it, not do it, but just consider it. One could be protecting yourself against future tax rate increases. And then the other is going to be tremendously, and this is the more popular one, is for legacy planning, right? A lot of the families today that know they're going to be leaving money behind, they don't want to leave a tremendous tax burden behind to their legacy. At the end of the day, it's the money that they earned, they saved, and so the taxes are going to be paid by their dollars. So if we can transition that more efficiently into a tax-free place for their future benefit as well as their future heirs, it makes perfect sense.
Yeah. I know we've talked about a lot today, so if anybody's listening to this and they want to get more information, they can just go to our website, pomwealth.net, and they can go there to the Contact Us page, and we'll walk them through their very own personalized plan. If you would like to find more information about Peace of Mind Wealth Management, we invite you to visit our website at pomwealth.net. If you go to the contact page and contact us, we'll send you a free copy of our book, The Peace of Mind Pathway. It lays out our process from beginning to end. Please visit our website.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.